In August 2025, trade between China and Russia hit a sudden wall. Chinese exports to Russia, measured in US dollars, fell to their lowest level since February and dropped 16% year-over-year. Russian shipments heading the other way fell even more steeply. For two capitals that have marketed their bond as an economic lifeline and a geopolitical counterweight to the West, the figures are not just troubling, they are warning light. The optics told a different story. Weeks after the downturn, Vladimir Putin stood beside Xi Jinping at a meticulously staged military parade in Beijing. There were red carpets, tight choreography, and cameras everywhere. From a distance, it looked like unity. Up close, the cracks were visible. Trust is thinning. China is edging away, leaving Russia more isolated than at any point in decades. This isn't a routine slowdown. It's the start of a strategic unravelling. For years, Moscow leaned on Beijing to stay afloat under Western pressure. After Russia's 2022 invasion of Ukraine, sanctions choked off finance, technology, and a large chunk of European energy demand. The Kremlin's answer was a pivot to the east. Chinese firms stepped into the gaps left by Western companies. Discounted Russian oil and gas poured into Chinese ports, and shelves in Russian shops refilled with Chinese electronics, cars, and components. In 2023, bilateral trade hit records. New energy deals were signed. The two governments talked up a multipolar world and boasted of a long-term realignment. That momentum has stalled. What went wrong? In simple terms, China bought what it needed, at the prices it wanted, when it needed it. In the first two war years, Beijing sprinted to secure cheap Russian oil, gas, and coal. It also sold consumer goods and hardware that kept Russian supply chains from seizing up. But now China's strategic stockpiles are healthy. Its domestic refining capacity has grown, and its energy transition, more solar and wind, is advancing. Beijing has no reason to keep purchasing at emergency pace just to prop up the Russian economy. Moscow is learning, painfully, that China won't overbuy to bail out a partner. The public messaging still speaks of friendship without limits. The reality is a careful, conditional relationship governed by risk, cost, and leverage. Beijing won't expose itself for Moscow when the price gets too high. And right now, the price is rising. Sanctions are the pivot. It's not only the measures imposed after 2022. A newer, harder wave targets not just Russian firms but foreign enablers, banks, tech suppliers, logistics, and finance that keep Russia's war economy moving. Chinese banks and manufacturers dealing in chips, precision machinery, or financial services for sanctioned Russian entities now face the threat of exclusion from the dollar system and Western markets. That threat is credible, and it matters. China's economy is slowing, its real estate sector is fragile, youth unemployment is elevated, and the banking system relies on dollar liquidity. Its exporters depend on Europe and the United States for profits. The risk of blacklists, asset freezes, or secondary sanctions is not one Beijing is eager to test. So China is trimming exposure. Energy purchases continue, but sensitive equipment deliveries have slowed. Big infrastructure projects are delayed or shelved. Compliance checks at Chinese banks have tightened, complicating Russian payments and credit lines. Joint ventures once presented as flagship cooperation are drifting into limbo. The tone has shifted from bold coordination to cautious hesitation. Technology is the sharpest barometer. Chinese tech firms have started to pause or cancel joint R&D with Russian counterparts in AI, robotics, and telecoms. It's not just sanctions fear, it's strategic calculus. Beijing wants to protect its access to Western technology and avoid reputational or legal blowback for transferring sensitive systems to sanctioned Russian industries. As Russian demand for high-end chips and cloud infrastructure grows, Chinese supply is tilting downward. Some shipments are routed through third countries, others are quietly dropped. It's a muted decoupling that reorders how the two countries interact. And for Russia, losing advanced tech may be more damaging than losing market share. It slows innovation, weakens defense manufacturing, and deepens the isolation China was supposed to offset. Western pressure is designed to raise the cost of aiding Moscow above the benefits. Washington is pressing for higher tariffs on Chinese goods if Beijing expands Russian oil buys and is pushing secondary sanctions that could hit Chinese energy, finance, and tech firms directly. Europe, meanwhile, has sharpened its stance. While EU governments keep diplomatic channels open, They are aligning more closely with the US on export controls and potential penalties for sanctions evasion. For Beijing, risking a €500 billion market in Europe is a different calculation than ignoring Washington's rhetoric. That market is central to stabilizing growth. Domestic Chinese politics matter, too. State media avoid criticizing Russia, but they rarely celebrate its war. Public attention is fixed on jobs, housing, and the economy. Among younger Chinese, enthusiasm for backing Moscow is tepid at best. There is little appetite to be drawn into someone else's costly conflict. That translates into a policy focus on economic stabilization at home, not on underwriting Russia abroad. None of this means the China-Russia partnership disappears overnight. Energy will still flow, border trade will continue, summits will yield upbeat statements. But Beijing is drawing clearer lines. The more pressure Washington and Brussels apply, the narrower those lines become. For the Kremlin, this is dangerous. The entire Go East strategy assumed China would always buy, sell, and invest regardless of the political climate. That assumption is breaking. It's not only China. India, crucial to absorbing displaced Russian crude after 2022, has cooled. From May to August 2025, Indian purchases of Russian oil fell by more than 30%. Spot cargoes are down. Long-term contracts are being quietly renegotiated, and refiners are demanding bigger discounts or shifting volumes back to Gulf suppliers. Insurance, shipping, and finance around Russia's oil trade face tighter scrutiny. For Indian companies, the association risks are rising fast. Unlike China, India lacks the economic heft to absorb sustained secondary sanctions pressure without significant collateral damage to its broader Western market access. The result? Russia's reliable buyers are acting more like opportunistic traders. This changes the structure of Russia's energy power. Once dominant in Europe and influential globally, Moscow now leans on a small set of buyers with more leverage than the seller. Nowhere is that imbalance clearer than with China. Despite the slogans and state photos, the relationship has never been equal. History holds plenty of rivalry, from border clashes in the 1960s to decades of competition for influence in the communist world. Today, China is a manufacturing superpower, the world's second-largest economy, and an expanding diplomatic actor. Russia is increasingly a raw materials exporter short of Western technology. China fills that gap not out of loyalty, but out of advantage. The leverage shows up across sectors. In energy, the much-touted Power Siberia 2 pipeline is a case study in asymmetry. With China as the only anchor buyer, pricing and timelines reflect Beijing's comfort, not Moscow's urgency. Europe once paid more than $400 per thousand cubic meters for Russian gas. China pays far less, closer to the upper $200s. Construction is slow, financing vague, deadlines slipping. For Russia, the pipeline is lifeline infrastructure. For China, it's one option among many, something to speed up, slow down, or resize as suits its broader energy mix. Geopolitically, the imbalance extends into Central Asia. Through the Belt and Road, Beijing has poured capital into roads, rails, and oil fields in Kazakhstan, Uzbekistan, and beyond. Those ties are sticky. Moscow's old influence, grounded in security alliances and history, is fading as regional leaders look to China for investment and markets. It's a quiet reordering that does not require a single shot, only years of financing. On security, limits are even clearer. Russia would like China to behave more like North Korea, brazen, confrontational, willing to ship munitions. Beijing won't. Sending lethal aid to Russia would trigger severe Western penalties and jeopardize China's crucial economic ties. North Korea, already isolated, calculates differently and has fewer costs to bear. China has global interests to protect and acts accordingly. All of this adds up to a relationship held together as much by appearances as by substance. Publicly, the bond is unlimited. In practice, it is circumscribed by compliance offices, price negotiations, and risk assessments. Russia gets diplomacy and selective trade. China gets discounts and strategic optionality. For Western capitals, the shift is instructive. The once urgent fear of a hardened China-Russia axis is giving way to a more nuanced picture, a transactional arrangement with uneven commitment and diverging goals. In Central Asia, the balance tilts toward Beijing. In Africa and the Middle East, China's financial weight outpaces Russia's capacity, In Europe, Beijing keeps doors ajar while Moscow faces shut ones. The upshot: containing Russia is easier when it has fewer reliable partners. Constraining China is harder because it still offers markets, investment, and participation in global institutions. For Moscow, this is a strategic come-down. If China won't be the anchor, who will? Iran and North Korea can move barrels and shells, but they can't substitute for missing technology, finance, or diversified markets. They are proof of how far Russia's options have narrowed, not a path back to resilience. Inside Russia, the strain is plain. Growth is weak. Banks are under pressure. Imports are constrained by what China still permits, and by the friction of sanctions. Industrial components are short. Inflation presses households. Officials project confidence, but their policies betray urgency. The Kremlin talks strength. The economy signals stress. China, by contrast, is practicing strategic moderation. It preserves its global image, calls for peace, keeps open ties across divides, and avoids direct entanglement in Russia's war. The stance allows Beijing to remain engaged with Europe, with the global South, and sidestep the isolation gripping Moscow. It also ensures every deal skews in China's favor, every barrel discounted, every contract written on Beijing's terms. Russia, with little leverage, accepts. That posture has limits. Beijing's distance prevents the relationship from deepening, which is precisely the point. The no-limit slogan was always more theater than blueprint. As pressure rises, the partnership becomes narrower, more transactional, and easier for Beijing to modulate without paying a heavy price. The ripple effects reach beyond the two capitals. Europe sees evidence that sanctions bite harder over time. Washington sees confirmation that Beijing won't burn bridges to save Moscow. Middle powers, Turkey, Brazil, Saudi Arabia, take note of Russia's diminished reliability and hedge accordingly. In Asia, China's main strategic focus remains the Pacific competition with the United States. Entanglement in Putin's war would only drain capital and risk markets. Hence the careful line: support Russia just enough to keep influence, never enough to trigger crippling penalties. Where does that leave Russia? Trapped in a partnership it does not control, tied to a power that is slowly stepping back. China will keep buying, but at discounts and on its timetable. It will show up for photo ops, not rescues. As the war drags on, the distance is likely to widen. The partnership without limits was never about friendship. It was about leverage. The consequences are clear. Russia's circle of dependable partners is shrinking. Its economy is steered less by its own ambitions and more by boundaries set elsewhere. Sanctions from the West, price caps from buyers, compliance screens in Chinese banks. The break will not be announced with fanfare, but it is happening in plain numbers, delayed projects, and contracts written in small print. For Moscow, that's the crisis, a gradual, quiet separation from the only major partner it counted on to offset isolation. The headline image of two leaders walking side by side still sends a message. But the substance behind the image has changed. China will take what it needs from Russia and leave the rest. It will avoid steps that endanger its growth on markets. And it will keep its options open, because that is what leverage allows. Russia once sold its pivot to the east as a sovereign escape route from Western constraints. It has turned into a funnel, narrower, steeper, and controlled from the other end.